When Mark received his first real paycheck at 23, it felt like a rite of passage, a quiet confirmation that life had officially begun, that he was no longer preparing for adulthood but actively participating in it. And like many people raised with careful values, his instinct was not to spend but to protect, because growing up he had heard the same message repeated in different forms by parents, teachers, and well-meaning relatives. Save your money, don't waste it, put something aside for a rainy day. And so Mark did exactly that, opening a savings account at a familiar bank branch with glass doors and smiling tellers, depositing a few $1,000s and feeling a small sense of pride every time he checked his balance and saw that it never went down, because to him that stability meant responsibility, maturity, and intelligence. And over the years, as his income grew, so did the balance, slowly but steadily, a few hundred here, 1,000 there, and each time he transferred money into that account, he felt like he was building a foundation for his future, something solid and dependable in a world that often felt uncertain. And for a long time, that belief went unchallenged. Years passed quietly, not marked by dramatic financial events, but by ordinary life. Rent payments, groceries, car repairs, small vacations, and the occasional emergency that the savings account handled without stress, reinforcing Mark's belief that he was doing everything right, that this was how responsible people managed money. And when friends talked about investing in stocks or index funds or real estate, Mark would listen politely but feel a subtle discomfort, because investing sounded like gambling, like inviting unnecessary risk, and he preferred certainty. He preferred knowing that his money was there, untouched, safe, waiting. And his bank rewarded this patience with interest so small it was barely noticeable, a few dollars a month at best. But that didn't matter to him, because growth was not the goal, preservation was. It wasn't until his mid-30s, when Mark started thinking seriously about buying a home, that the illusion began to crack, because as he scrolled through real estate listings, something felt off. The prices seemed unreal, inflated beyond reason. Homes that once felt attainable now seemed distant, almost abstract. And when he finally sat down to compare his savings balance with the actual cost of a down payment, a strange realization crept in. The numbers no longer aligned with his expectations. The money he had so carefully protected for over a decade did not carry the same weight it once did. And in that quiet moment of confusion, Mark confronted a truth that most people never consciously face. Money does not stand still, even when it appears to. This is where the story stops being about Mark and starts being about all of us, because what Mark experienced is not bad luck or poor planning. It is a fundamental misunderstanding about what money actually is, and that misunderstanding is at the heart of what can be called the savings account illusion, the belief that money stored safely in a bank remains intact over time, when in reality its true value is slowly eroded by a force so constant and familiar that we barely notice it: inflation. Inflation is often discussed as an abstract economic concept, a percentage on a chart, a headline on the news. But in practical terms, inflation is simply the rising cost of living, the gradual increase in prices across nearly everything you buy: food, housing, transportation, healthcare, education, and energy. And while a single year of inflation may feel insignificant, especially when it sits at 2 or 3%, its real power lies in compounding, because inflation does not pause, it does not reset, and it does not care whether your income or savings keep up. It compounds year after year, silently reducing the purchasing power of every dollar you hold. This is the first concept that most people never fully internalize. A dollar is not a unit of value, it is a unit of purchasing power. And purchasing power is not fixed, it is dynamic, relative, and constantly changing, which means that looking at a bank balance tells you almost nothing about what your money can actually do in the real world, because nominal value, the number you see on the screen, is not the same thing as real value, which is what that money can buy. Between 2010 and 2024, cumulative inflation in many developed economies exceeded 30%, meaning that something that cost $100 at the beginning of that period cost roughly $130 by the end. And when you apply that reality to money sitting idle in a low-interest savings account, the implications become unsettling. Because while your balance may appear stable, your purchasing power is steadily shrinking year after year without any visible warning sign. This is why savings accounts feel safe while being quietly destructive, because they protect nominal value while sacrificing real value. And human psychology is wired to care far more about what we can see than what we cannot, a concept known as loss aversion, where visible losses trigger emotional pain far more strongly than invisible ones. And banks benefit enormously from this cognitive bias, because a savings account never shows you the real loss. It never flashes red. It never drops suddenly. It simply stays the same while its ability to support your future weakens. To understand how damaging this can be, consider a simple example. Imagine you have $50,000 sitting in a traditional savings account earning 0.5% annually, while inflation averages 3%. After 1 year, the loss feels trivial, barely noticeable, but after 5 years, your purchasing power has dropped meaningfully. After 10 years, you have lost over a quarter of your money in real terms, and after 20 years, nearly half of its original value is gone, not because of a bad decision, but because of inaction. What makes this even more unsettling is that while your money sits passively in your account, the bank is actively using it, lending it out at significantly higher rates, funding mortgages, business loans, and credit card balances, earning substantial returns on your deposits while paying you almost nothing. And this is not a hidden scheme or a moral failure. It is simply the business model of modern banking. Banks profit from the spread between what they pay depositors and what they earn from borrowers. And this spread, known as the net interest margin, is one of their primary sources of income. In effect, when you leave money in a low-yield savings account, you are subsidizing the bank's profitability while your own purchasing power erodes. And this asymmetry persists because most people never calculate the real return on their savings. They see interest as a bonus rather than a defense against inflation, and as long as the balance does not go down, they feel secure. The contrast becomes even clearer when we compare savings accounts to long-term investments, particularly diversified equity markets, which historically have outpaced inflation over extended periods, not without volatility, not without risk, but with a strong record of real growth. And this introduces one of the most misunderstood distinctions in personal finance, the difference between volatility and risk. Volatility refers to short-term fluctuations, the ups and downs that make headlines and trigger emotional reactions. Risk, on the other hand, refers to the probability of permanent loss of purchasing power. And while stocks are volatile, inflation makes cash predictably risky over long time horizons. Because its direction is relentless, it only moves one way. This is where many people get trapped. They avoid investing because they fear visible losses, choosing instead the invisible loss of inflation. And over time, that choice can cost them hundreds of thousands of dollars in missed opportunity, not because they were reckless, but because they were overly cautious in the wrong way. High-yield savings accounts complicate this conversation slightly because they offer interest rates that sometimes approach or even exceed inflation, temporarily preserving purchasing power, and they are unquestionably better than traditional savings accounts, but they are not a long-term solution because their rates are tied to broader monetary policy, and when interest rates fall, which they historically always do, the real return on cash returns to negative territory. The correct way to think about savings accounts is not as wealth-building tools, but as liquidity tools. They are meant for money you need soon, emergency funds, short-term goals, and psychological stability, not for long-term growth. And when used correctly, they serve an important purpose, but when used excessively, they become a drag on your financial future. A practical framework can clarify this distinction. Calculate your monthly expenses and multiply them by 6. This is your emergency fund, the money you keep in a high-yield savings account for protection against life's unpredictability. Add to that any known expenses within the next 1 to 2 years, and beyond that, excess cash should be allocated to assets designed to outpace inflation, whether that's diversified index funds, real estate, or other appropriate investments based on your circumstances. Holding more cash than necessary is not safety, it's an unpriced